Hi, I'm Spencer Tierney, NerdWallet's expert on certificates of deposit. If you're looking for a way to earn more interest on your savings, certificates of deposit, or CDs, have the advantage of fixed rates that regular savings accounts don't have. You can compare CD rates by checking their annual percentage yields, or APYs, but a higher CD APY doesn't necessarily mean a higher return. You need to compare CDs by term length as well. Let's dig in. So an APY is the rate of return after 1 year, assuming you're earning compounded interest at the same rate for 12 months. CD terms, however, typically range from 3 months to 5 years, and traditionally, the longer the CD term, the higher the rate, but a recent trend has flipped that, so you can find higher rates on terms that are shorter than 1 year. So if you're eyeballing CD rates without considering the term length, you might think some short-term CDs are better deals than they really are. Say you find a 4% APY on a 6-month CD. That 4% assumes a year's return, not the 6 months of that CD. So 6 months is half a year. You get roughly half of that 4%, so about 2%. Now, if you line up a second 6-month CD at 4%, then yes, for that full year, you will end up with a 4% return. You can test out other scenarios using a CD calculator. CDs less than 1 year can work for short-term savings goals, but don't ignore long-term CDs because of lower rates alone. In fact, there's more risk in hopping from one short-term CD to the next because the rate on each new CD may drop. Remember, a CD's fixed rate only lasts as long as that CD is in a customer's hands. Banks tend to change their CD offerings regularly, so rates could drop. If you're ready to consider a CD, estimate your return using NerdWallet's CD calculator, and remember to factor in the APY and the term length, not just APY.